Good morning, everybody. Hopefully you had a wonderful late spring weekend and the weather treated you well. So a couple things to talk about today. U.S. money supply is doing something it hasn't done in 90 years, and it may signal a big move for stocks. So what is that? For the past 16 months, professional and everyday investors alike have been taken for quite a ride. The HS Dow Jones Industrials, the S&P 500, and the growth-driven NASDAQ all entered respective bear markets, produced their worst full-year returns in 2022 since the Great Recession. The M2 money supply hasn't done this since 1933, and investors should take note. There are a couple of money supply measures for those of you that aren't fresh on your macroeconomics from college. The two investors and economists focus on are M1 and M2. M1 is all the cash and coins currently in circulation, along with things like traveler's checks. It's easily accessible that can be spent immediately. However, M2, which is where most people look at, M2 takes into account everything in M1 as well as savings account, money market account, certificates of deposit less than $100,000. In other words, money people can get to, but it takes a little extra work. This latter measure, M2, is where we're seeing something truly historic at the moment. So as you can see in the tweet from Charles Schwab, Chief Investment Strategist Liz Ann Saunders, U.S. M2 money supply through March has fallen 4.1 on a year-over-year basis. So through March, M2's money supply has fallen 4.1% a year, decisively the worst rate all the way back to the 1960s. Declining money supplies in combination with the above-average inflation is generally bad news for the U.S. economy. And if the cost for goods and services keeps climbing at an above-average pace, there are a few dollars in coins in circulation to pay for these goods and services. Something typically breaks, leading to a period of deflation and economic downturn. But Saunders isn't the first, nor would she be the last to call this historic decline in U.S. money supply. Less than 2 months ago, because remember, she said that in March, Nick Gurley, founder and CEO of Venture Consulting, relied on the historical M2 and U.S. inflation rate from the Federal Reserve of St. Louis and U.S. Census Bureau to come up with the timeline of U.S. money supply growth and contraction dating. Picture that can be painted. So he went back all the way back to 1870. He said this reflected in the tweet sees here. Warning, the money supply is officially shrinking. This has happened only 4 times in the last 150 years. A depression followed each with a double-digit unemployment rate. So shrinking M2 has only happened 4 times in the last 150 years, and a depression each time with a double-digit unemployment rate. Now, considering that Gurley's tweet is almost 2 months old, and that there's been an additional 2% drop that's depicted in the right now of 4.1, we can see that this is the first drop in M2 money supply in 90 years. There is a decline. With the exception of the Great Depression, this is the second largest decline in M2 money supply in more than 150 years. So that's M2, guys. And what's happening to credit card debt, guys? Where's credit card debt? Up. So we got M2 that's extremely low. We've got credit card debt that's way up. How many are we at record or non-record people who are behind on their car payments? Record or not record for people behind on their car payment? Record. So these are all things saying what? That we're set for a economic expansion, or people have taken the spending up to the very brink of I can't do this anymore. So Gurley notes that the 4 previous instances of M2 contraction led to 3 depressions, 1870, 1920, and the Great Depression, and 1 panic in 1893 with correlated spikes in the U.S. unemployment rate. M2 foreshadows a recession. Here's why it matters to investors. The major takeaway from only the 5th decline in M2 money supply since 1870 is that there is an increased likelihood that a U.S. recession is shaping the near future. Although the Dow Jones Industrial, S&P 500, and NASDAQ do not reflect the ups and downs of the U.S. economy, remember, are the stock markets directly related to the U.S. economy? No. But are they reflective of each other? Yes. So no bear market since World War II has bottomed before 8 economist panels of the National Bureau has declared an official recession. No bear market since World War II has bottomed before the 8 economist panel of the National Bureau has declared an official recession. And have they declared an official recession yet? No. So that means We're likely at the bottom, or we're yet to see the bottom of the market. So economic research, in other words, a big if we are headed bearish, the exception would be to take stocks haven't yet seen their bear market declines. In addition, data from Bank of America research shows that 2/3 of the peak to trough downturns or drawdowns in the S&P 500 since 1928 have occurred during recessions and not before one was declared. So we've got how much economic data saying we have yet to see a bottom to the market? A lot or little? Dough heads, talking heads, or actual research? Yeah, so again, am I saying pull all the money out of the market? No, but I'm certainly saying what? Don't what? Don't put money into the market. Don't add to the market. And where should your clients be? They want to hedge their bets, which all your clients should be. Remember, you're dealing with, are your clients trying to get wealthy, or they're trying to make sure they don't get poor? So make sure you're using at least that 60-40, 50-50, 40-60 FIAs with the with your market investments. Make sense? Cool. So today I want to share a super presentation because this ties right into, hey, if there's going to be people still need income, the market's going to go kaput on them, or we haven't seen a bottom. How would they do that? Well, our sale does a great job of that. And two of our longtime advisors who we love, Bonnie and Michael, have been innovators for years on marketing, innovators for years in presenting. They're both highly skilled financial advisors, highly skilled presenters, and extremely creative. That's a trifecta that's very, very rare in this business. And they shared a while ago a presentation they put together for sale. So here's the presentation they have. It starts with, here's the question we're faced with. And again, they're talking to retirees. Should some of our future money be set aside to produce future income? So how many people say yes to that? In a seminar, how many people say yes to that? Should some of our money be set aside to produce future income? How many people are living on pensions and Social Security only? Yeah, virtually nobody anymore. Second question we have is, should we set some of our money aside to participate in the stock market for potential growth? So should we have all of our money set aside for income? Should we have all of our money in the stock market for potential growth, or we should do a what? Combination of what? Both. So the big question is, how important is a predictable, reliable income to your retirement? What do people say to that? Very important. And that's why we introduced the Smart Asset Income Ladder, what we call the SAIL. The Smart Asset Income Ladder provides a shield for both income and growth. Income and growth. It gives you income, but allows, with very predictable income, but allows growth as well. So the Smart Asset Income Ladder, it's a mathematical calculated ladder that allows you to make systematic withdrawals of income from assets without the worry of drawdowns, without the worry that markets going down are going to cause you to run out of money. So let's look at an example of this. Richard has $500,000 in his IRA, and he needs $2,000 a month, which is how much? $24,000 a year. So what we would do is we're going to have three assets here. We're going to take your whole pile of assets and divide them into four piles. Asset 1 is pile 1, asset 2 is pile 2, asset 3 is pile 3, and asset 4 is pile 4. Or so buckets: bucket 1, bucket 2, bucket 3, bucket 4. As if you had a bucket of, you put all of your money into buckets of cash. So we're going to allocate this first bucket with $116,000 of his $500,000. Okay. The second bucket we're going to allocate of the $500,000. We're going to put $111,996 in there. The third bucket we're going to put $46,000. Oh, I'm sorry. What am I doing? All right. We're going to put 97 there. We're going to put 36,000 there. We're going to put 250,000 in the fourth bucket. So half the bucket is going to be in the bucket number 4. That's the entire $500,000 that we have. Now, here's what's going to happen. Is during that, from age 65 to 70, he's going to be using this money right here for his $24,000 a month. So for the first 5 years, he's going to be using this money for his $24,000 a month. What's happening if he's not touching bucket number 2, number 3, and number 4? What's happening to it? It grows. That's right. It grows. But after 5 years, guess what's happened to bucket number 1? It's empty. That's right. But now we have what? In bucket number 2, we have the 97,000 has grown to 112,000. The 36 is going to 46. The 250 is going to 337. So for the next 5 years, between 70 and 75, we're going to spend this bucket to give him his needed income. But we're not going to touch bucket number 3 and the bucket number 4. So what's going to happen to those? They're going to continue to grow. So this one goes from 46 to 59, 337 to 454. So we've actually, even though we've been pulling out $24,000 a year, we have more money at the end of those 10 years than at the beginning. So essentially, we've taken these first 2 buckets and we're using these for income for the first 10 years. First 10 years, from 65 to 70 and from 70 to 75. We've used this for income. That has allowed what? These 2 buckets to continue to grow. And like we talked about, at 5 years later, the first bucket is gone, but then we're going to pull from here. Then after 70, from 70 to 75, we're going to pull from this bucket, and then that's gone. But then we have this bucket for year 10, and this one for growing after year 10. So essentially what we're doing is at year 10, from age 80 going forward, we're going to pour this bucket number 3 back into buckets number 1 and number 2. See what we're doing? Because remember, these buckets are what? These 2 buckets are what? Spent. But these 2 buckets have grown, have done nothing or have grown. They've grown, right? So now what we're going to do is we're going to take that bucket number 3, which has grown, and we're going to refill buckets number 1 and bucket number 2. And then we're going to allow number 4 to what? Continue to grow. So if bucket 4 refills, and then down the road, bucket 4 will refill bucket number 3 for growth. And guess how long we can continue to do this? Over and over and over. So has it given you predictable income, but still allowed you to grow? So we're positioned for 10 more years predictable income at age 85 to age 95. So we're going to keep doing that over and over, because at age 86, we'll fill bucket number 3, we'll fill bucket number 1 and number 2. 10 years later, we'll do the same thing over and over and over again. So we look at here, at age 85, remember we start at age 65. Now we're 20 years into the future. This bucket's going to be 162. Bucket number 2 is going to be 156. I'm sorry, 162. Bucket number 2 is going to be 135, 18, and 106 in bucket number 4. That gives us our balance right here. At 90, bucket number 1 is gone. So we'll start using bucket number 2. At 95, we'll start using bucket number 3 and 4. So after age 95, you still have 224. So it gave you all of the income. And were we ever worried about running out of money during these 20, 40 years, right? So 65, over 30 years. Did we ever worry about running out of money during those 30 years? Or did we have a consistent income coming and allowing our growth to happen over here with buckets number 3 and 4? So even at the end when we did it, we still have 45%. And that's if our growth money only makes 5 or 6%. What does the market normally do? 5 or 6 or even higher? Even higher. And why? Why can we allow buckets number 3 and 4 to be in the market? Yeah, because the first time we're ever going to tap number 3 or 4, bucket number 3 or 4 is when? How many years in the future? 10 plus years. So we're confident that the market over 10 years will grow nicely. So we're being aggressive or conservative in the amount of money we think we can make in our market investment. Very conservative. And yet we're at age 95 and still have not run out of money. So the big question is, how important is predictable and reliable income to you in retirement? And we all said at the beginning it was what? Very predictable. So what the sales strategy can do for you is it replaces that work paycheck, that paycheck you got every 2 weeks while you're working. with your new retirement play check. That play check is predictable, it's reliable, it guarantees that predictability and reliability of your income. And yet it still does what? Grows and grows and grows, keeping you ahead of inflation. So if you're interested in the sales strategy, mark the box on the form, and we'll be happy to sit down with you and run your situation through the sale strategy software so you can figure out how it would work for you. So does that do a good job of visually helping people understand how the sale works versus just a table? So these slides are, again, thank you, Michael and Bonnie. Like I said, they have they are the trifecta. They're creative. They're consistent. They constantly and they know their clientele and how to communicate with them. So thanks for sharing that here. It was a few years ago, but I thought it was a good refresher for everybody to see that again. We showed it to people here a while back, and those slides are available. You can call Tricia and she can get those slides to you. But is that guys? Do you like that presentation visually? And does it do a great job of just rather than just having this chart? Yeah. So thanks again, Michael and Bonnie.
And for those of you that are asking for them, because there is a handful, so I'm going to go ahead and post them right along with the call just to kind of keep it all together. So you'll be able to download the presentation with those slides directly from the call replay as well.
Coolio. So today in our journey through the 21-point checklist, we're going to talk about turnover costs. So turnover costs, the bullets, again, can you have these bullets on your copy of the 21-point checklist as you sit down with the client? Yes, absolutely you can. So the first thing we're going to talk about is with the turnover, we're going to say, when we buy stock, should we buy and hold or should we buy and sell? What does everybody say when we ask, should we buy and hold or buy and sell? What does everybody say? What's been pounded into their heads? Buy and hold. Now, why are we doing that? If they've said buy and hold is the right thing to do, if they've said their advisor said buy and hold, have we just won the whole conversation when we talk about turnover? Yeah, they've just validated that what they're doing is stupid and that their advisor is talking out of two sides of his mouth. He's saying buy and hold, but when it comes to him, he's buying and selling. Does that make sense? So now, do we talk about their turnover first, or do we get them to lock in buy and hold is a better thing to do first? Is it harder to say, hey, you got a lot of turnover, that's bad? Is it harder to get them to agree with that, or is it harder to get them to agree to? Or let me reverse that. Is it easier to get them to agree to, hey, you should buy and hold, or you're screwing up because you're buying and selling? Which one's easier? Buy and hold, or you're screwing up? Buy and hold, or you're screwing up? Buy and hold is way easier. Everybody says buy and hold is way easier. And then we're going to lock that even in further. We're going to talk about company turnover. Company turnover. So if you own a McDonald's, and you're constantly losing people, how well is your McDonald's going to be running? Well or poorly? How good is your customer service going to be? How many screw-ups are there going to be? How much food is going to go into the garbage? What's going to happen to your clientele when every time they come there, it's slow service because everybody's a beginner, it's crappy food because nobody knows how to do it, and the orders are screwed up constantly because they can't get things right. So company turnover is a good thing or a bad thing for a business holder? How many people are going to say company turnover is a good thing? They're going to say it's bad. Everybody says that. So no, they said 100% have said buy and hold is better. 100% of people said turnover is bad. 100% says buy and hold is good. 100% said turnover is bad. Okay. Now they've completely locked into what? That their situation is good or bad? Bad. Now, but I did this before I started to talk about their current situation. Then we go into investment turnover and we explain the math. So, and we'll go through that. You'll see how we do that in the video. So they'll say, oh, I understand why turnover then is expensive. Then after we talk about 100% said buy and hold is good. 100% said turnover is bad. They all now understand why turnover costs a lot of money for their accounts. then we talk about their turnover. Because at that point, can they backpedal? See, we're going to talk about all these things before we talk about their turnover. So if they backpedaled at this point and said their turnover is a good thing, they look what? Because I did used to have, the reason we do this is because, have you ever, maybe you didn't know the script as well as you should have, and I know when I was developing the turnover script, when I would just jump in and say, look, your turnover sucks, and let me explain to you why that's bad, you know what the client would say? Well, no. They're constantly selling the bad stocks and getting me good stocks. They're selling the bad stocks and getting me good stocks. So they're managing the account. They're doing a good thing. Now I have to what? If they do that, before I have them say buy and hold is the best, turnover is bad, turnover in investments is bad. If I just have them jump right into their turnover, guess what they started to do? To defend. Because again, and when they're defending, are they really defending their advisor when they're defending? No, who are they defending? Themselves. So I have to get them to say these things up front, because if they agree that all these things, 100% of people agree, these are 100% correct, 1,000% correct, can they then argue that turnover for them, though, is a good thing? They'd look like what? Idiots. And do they want to look like idiots? No. Does that make sense? So we first of all talk about third party, then we talk about their turnover, but then we say, hey, but you're doing it right. You told me these things right. You buy and hold. You buy and hold. You're a good guy. It's what your managers are doing that are what? Bad. So let's take a look at how we do this. We'll go up here. So a couple of things. We're going to be filming the cover is turnover costs. Now, when you heard about investing, did they tell you to buy and hold or buy and sell willy-nilly?
Oh, no, buy and hold.
Buy and hold, right? So that's smart. That's what all the research shows. That's what all great investors and the people have said in the long term, that you should buy and what?
Buy and hold.
Yeah. And so turnover is talking about, well, let me give you an example of what turnover is talking about. If you hear a company has a high turnover ratio with its employees, does that mean it's holding its employees a long time, or it's a revolving door with employees coming in and out, whether they're quitting or getting fired or whatever? Which one?
Revolving door.
Do you think that's a good thing or a bad thing for a company?
Well, I would guess that's a bad thing.
That is a bad thing, because if you think about it, first of all, does it cost money to hire people?
Oh, yeah.
And when they're being trained, is that downtime or they're productive?
No, that's downtime.
So if they're constantly doing that, what's it going to do to that company?
It's going to affect the bottom line.
It's going to affect the bottom line. So high turnover is good or bad for a company?
No, it's bad.
Yeah. And it's the same thing for investments. So for investments, they don't have employees, but let's say that with the companies we just talked about, do you think they have one stock in it or maybe 100 stocks?
I'm sure they have 100.
100 stocks. So if they don't get rid of a single stock at the end of the year, so the same stock they started with in January, they have December 31st, what is their turnover going to be?
Zero.
Zero. If they sell all 100 stocks and then replace them with 100 stocks, what would their turnover be?
100.
100. So what your particular turnover is, do you see how I make sure that he understands the math beforehand? And did I make it really complicated math or pretty darn easy math? Complicated or easy? Have 100 stocks to begin with and you sell nothing, what would the turnover ratio be? Nothing. If you have 100 stocks and you sell all 100, what would the turnover ratio be? 100. So, but does he understand now, at least basically, the concept of turnover inside a portfolio? Yes. If we look at Morningstar, what they tell us is the turnover ratio. Do these look familiar to you?
Yeah.
Okay, those are your funds. So your turnover ratio is everywhere from 97, which is what?
Practically 100.
Yeah, to smaller, but on average it's what?
46.45.
And where are we here?
46.45.
Yes, so that's where you're at right now. Now you told me that it was a good thing or a bad thing to do buy and hold.
Oh, buy and hold is good.
You get it. You're. So I've just told him he gets it. Remember, the template for these scripts is what? we always begin the script with you're a smart person, whether it's diversification, turnover, power of attorney, whatever, you're a smart person. So we're doing the same thing right here.
You know what to do here. What do we find when we pull the curtain back? What do we find out your managers are doing?
Oh, they're buying and selling.
So who's smarter?
Well, I would think I am.
It certainly starts to appear that way, right?
Yeah.
So, but we're wondering, well, why? We know why turnover is bad for companies. Why is it bad for investing? Should we kind of walk through?
Sure.
It's got three different problems. Number one is, have you ever heard of capital gains?
Yes.
Okay. So capital gains. And what are capital gains?
So if you have an investment and it goes up, you have a capital gain and you have to pay tax on the gains.
Right. And have you heard of the term short-term versus long-term capital gains?
Mm-hmm. Yeah.
Okay. So what do you know about those?
Long term, you pay less tax. Short term, you pay more.
Yeah. Short term, you actually pay half the tax. Or sometimes, depending on your tax bracket, even less than half the tax. So if you had your druthers, or if you could choose, would you rather have more long-term or short-term gains?
I think you meant to say double the tax.
Well, with the short term, you pay half. Oh, you're right. Thank you. Sometimes I need somebody like you. So we don't want half, do we?
No.
We want what? If you see me making a mistake, you call me out on it, right? So we're going to pay how much extra tax there with the short term?
2 times.
Yeah, which is good or bad?
Oh, that's bad.
Yeah. So if we wanted more long-term, or do we want more short-term?
You want more long term.
Yeah, we want more long-term. So when we, do you know the definition of a long-term is? If you hold the stock for what period of time is it considered long-term?
A year or more.
A year or more. So if it's a year or less, it's going to be what?
Short term.
Short-term. With half as much tax or twice as much tax? Twice as much tax. So if they have a 46% turnover every year, that's more than a year or less than a year?
Oh, that's going to be less than a year.
So what percentage of your funds are paying twice as much tax?
About 46%.
Good thing or bad thing?
No, that's bad.
Yeah. Now the second thing is this: is that we said that they have 100 stocks in there and billions of dollars of investments. Mm-hmm. So do you think that each stock they have $1 million of each stock, or maybe $100 million of each stock?
I'm sure it's more like 100 million.
100 million of each stock. So if you have if you're trying to sell your house and there's 15 other houses for sale on your block, what's that going to do to the price of your house?
It's going to lower it.
Lord, if you're the only house for sale in a great school district for 5-mile radius, what's that going to do to your house value?
It's going to make it go up.
Go up. So if everybody's selling, it's going to make it what?
Go down.
If nobody's, or if you've got something that everybody wants.
So again, I'm using a third-party analogy. Just everybody understand the whole concept that if on their block, every house is for sale on their block, the price of their value of their house goes down. Does everybody understand that? Yes. And does everybody understand that if you are in a very desirable neighborhood and you're the only house for sale, that your value of your house will go up? They all get that. And I have them agree with that before I actually then go and talk about the stocks.
It's going to make it go up.
And it's going to make it go up.
And that's why it affects you. So if they start out with $100 million of a stock and they want to sell it, they're going to dump it. So what do you think is going to happen to the price of that stock as they start selling that stock with $100 million during one day?
Oh, I'm sure it's going to make it go down.
They'll go down a little, keep going down, down, down. So you won't lose a lot, but by the end, instead of you start out with $100 million of stock, by the end they sell it and they only have $99 million worth of cash.
Okay.
So how much did that go down?
$1 million.
$1 million. And what percentage would that be?
1%.
1%. So they start out with 100. We're at what?
99.
Now they want to buy another what with that?
They're going to buy another stock.
So if they're buying stock, what's going to happen to the price of that stock if they're buying $99 million worth of stock?
It's going to go up.
It's going to go up. So now by the end, because they buy less of that stock as it keeps going up as they buy it, they end up with $98 million of the next stock. So what's happened there? How much did it cost them percentage-wise?
Another 1%.
So they're out how much?
2%.
2%. So that's the second. This is the first thing. Good or bad for capital gains?
Well, it's bad for capital gains.
Good or bad for cost?
It's bad for cost.
Okay. And the third thing is this, is that if I want to get an above average return, do I take more risk or less risk?
You're probably going to have to take more risk.
Take more. So I'm already down 2%. What do I have to do to get back to ground even at least?
You've got to at least make that back.
More risk. So what are the 3 reasons why turnover is not good?
Well, more taxes. You lose money, and you have to take more risk.
2.
So who said turnover is bad now? How many times have I had them say turnover is bad? Once, twice, 3 times, 4 times, 5 times, 6 times, 7 times? How many times have I had them say turnover is bad? Many times, many times. And did I say it or did they say it? Have I ever said turnover is bad, guys? Nope, it's always them.
Get back to ground even.
Right. So turnover-wise, try this again. Turnover-wise, do you want higher turnover, or do you want lower turnover?
Well, you would want lower turnover.
You want lower turnover. And you have what?
We have high turnover.
High turnover. And would you?
So what color did I use to circle the thing that they want? What color did I use to circle the thing that they want? Green. And what color did I circle what they have? Red.
Would you want high fees or low fees?
Well, you definitely want low fees.
Low fees. And not high fees. And what do you have?
Oh, we have high fees.
High fees and high what?
High turnover.
So, why do you think this, were you ever shown anything like this before?
No, actually, I've never seen that before.
So, which one would you rather have?
Low turnover with low fees.
Instead, you have
high turnover with high fees.
So you're paying more or less for what?
So again, did I tell him he has paying high fees and high turnover, or did he tell me that he's paying high fees and high turnover? Is that a small difference or a big difference for making him say it versus me? Is that a small or a big difference? It's a huge difference. That's right. I'm going to back it up just a second here, too. I don't want you to miss this, what's happening right now. Okay. Okay.
Have.
Low turnover with low fees.
Instead, you have
high turnover with high fees.
So you're paying more or less for what you...
Well, we're paying more.
For the thing that you truly wanted or the thing that you didn't want?
Well, for the thing we didn't want.
So why would you be being charged more for the thing you truly want instead of paying less for the thing that you truly want? Why do you think you're paying more?
Well,
if there's more of these, what can happen?
More for him.
So why do you think you're in something with high turnover?
Well, he wants to make more money.
Wants to make more money. Because here's the thing. Did you know that funds in the 90th and 95th percentile for return, guess what kind of turnover they have?
Low.
So, guys, the funds in the 90th and 95th percentile, what turnover do they have? 0, because they're what? What funds are those? The indexes, right, Steve? They're indexes. Why doesn't their advisor show them the index? Why didn't their advisor show them the index? Yeah, no load. They didn't make no money.
Almost 0. So you could have been in the funds that you're in, or you could have been in funds that perform. If you're in the 90 or 95th percentile, in the top 5-10% of all funds out there, is that okay or not okay?
Well, that'd be ideal.
And if you didn't have to pay any turnover fees on that, is that good or bad?
That would be great.
Yeah. Were you shown those?
No.
So instead, you're paying how much?
Well, about $3,700.
In needed or unneeded fees?
Unneeded.
Yeah. So that's the second. So we've already talked about the one with the unnecessary life insurance. Now we talked about the second unneeded fee.
Right.
We'll talk about the third here in a second. But if you had your druthers, you'd rather have what?
Low turnover.
And low
fees.
And the reason you not is why?
Well, he never showed us that.
Yeah, and he didn't, because why? If you have low fees, guess what?
He doesn't make any money.
So the next thing.
Now remember, guys, is this the first thing we've talked about, or are we well into the 21-point checklist at this point? We're well into the 21-point checklist. So how easy is it if I've done a good job, how easy is it for him to say that the guy did this to make more money on me? Because this is the first time I've had him say it, or is this, we've already been through we've been through everything. See how it's getting easier and easier for him to say, my guy is what? Screwing me. Does that make sense? So, and also, are you starting to see that there's templates that we use here over and over? So once you learn one script, it should get easier and easier and easier to learn all of the other scripts. Make sense? And then who does the math for you for how much turnover costs? Who does the math for you? Not how much turnover is. You have to discover how much turnover it is and then put it into from Morningstar. But then we put it into what? The 21-point checklist software. And then it calculates it for you. And we used, there's many different resources on how much turnover actually costs people. We didn't use the cheapest. We didn't use the most expensive. We went right in the middle for how much turnover costs. But do they get the explanation when I say if you dump $100 million worth of stock on the market, it's going to do what as you sell it? It's going to start to what? Go down and down and down. And when you buy $99 million worth of stock on the market, what's going to happen? It's going to start to go up, not a lot, but a little. But adding those two things, the buy and sell, is that complicated to them, or does that make total sense to them? And remember, when you look at Forbes and the articles that they've done, when you look at Kiplinger's and the articles they've done about hidden fees is talking mainly about what? Turnover is a huge chunk of hidden fees. There's other ones too that we talk about, like what? Not proprietary funds, but sponsored funds. There's all sorts of other things. But turnover is a huge, huge, huge part of fees that they never ever hear about. So does that make sense? Super. So that is our call for today. For those of you be on the script call, we finished at 20 till. We're going to start at a quarter till to do our script workshop. So we'll start in about 5 minutes and start at the quarter to the hour. So you guys that are going to be there, I look forward to seeing you. Everybody else, have a great week, and we'll talk to you all next Monday. Thanks, everybody.